guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And so, guys, with that, in this episode, I'm going to flip the script quite a bit, and instead of the usual guest that I would normally bring on, I'm going to invite my good friend and co-founder at Sunrise Capital Investors, Brian Spear, and he's going to join me here on the show today. And really the reasoning behind this, changing it up a little bit, it's really twofold. First reason is, we often get inquiries, from listeners of this show who request that I do more shows that provide a behind the scenes look at my own real estate business. I used to do this years back. I used to give regular updates on really what we're up to, different deals we're working on, case studies and things like that. As you're well aware, if you've been a listener for some time, the majority of the shows over the last couple of years are more of me interviewing others about their real estate business. And again, very rarely do I ever provide, insights as to what we're up to or what I'm up to in my own company. And so that's first reason for changing this up a little bit on you. The second is that, we are nearing a significant milestone at Sunrise Capital Investors. And that's the wrap up of our SCI Growth and Income Fund 3. And this particular fund is closing on August 31st. So here, just in a couple of months, it's going to be closing out for good. And as you might suspect from the name, this is Sunrise's third fund. And I'd say that it's important to note that, we've been at this for more than 2 decades. We've done hundreds of deals over that time. And so while this is our third fund, again, we've been at this for a very, very long time. I've done, hundreds of transactions. And guys, not only is this our third fund, but it's also the largest fund, and it has more than $130 million of assets under management in this particular fund. And, we launched this back in October of 2020. And since that time, we acquired 9 different assets inside of Fund 3. And we've been able to create more than $20 million of sweat equity for all of our partners. And so that's definitely something we're super excited about and something we'll talk a little bit more about here today. In addition to those 9 assets, we also have 2 more mobile home parks under contract that will be closing inside of Fund 3, which will take us to a total number of assets of 11 inside that particular fund, again, before we close the doors here on August 31st. And so if you'd like to learn more about me and my team, or would like to partner with us inside of Fund 3, and again, take advantage of that $20+ million sweat equity and an already performing portfolio, before it wraps up on August 31st, be sure to go over to investwithsunrise.com to learn more. In addition to Fund 3, you can also get on our list to be notified when we actually have new investment opportunities launched. And so with that, guys, I'd like to now take a moment to introduce my business partner and the co-founder of Sunrise Capital Investors, Brian Spear. Brian, how you doing today, my friend?
Good, man. It's good to be here. But you say, co-founder, business partner. You forgot to say friend, buddy, pal.
I said friend in the beginning. I think everyone's aware. Great friend, great friend.
Good, man. It's good to be here.
Yeah,
man. Good to be here.
Yeah, excited to have you, man. So again, most folks, again, they get to hear me all the time. I know you've done a few different podcasts here on the show over the years, but for the most part, they get to hear me ramble on and on each and every week. And so what I love to do, again, we don't spend too much time on this show talking about the company, right? Sunrise. I mean, this is what we do day in, day out. I'm not just a podcast host. We don't just do podcasts or create content. We run a legitimate business, and we've been doing this for many, many years now, but you're typically kind of behind the scenes. And so I would love for you, if you would, Brian, take a few moments and tell the listeners a little bit more about yourself, maybe more specifically, your role at Sunrise. Like, what do you do? What do you do inside the company?
Good stuff, man. Yeah. I tend to be long-winded. I'll try to be brief here, right? When you start a company, there's a ton of different stuff that needs to be done. And oftentimes you wear multiple different hats along the way. So over time, we've been fortunate to maybe delegate and elevate out of a lot of those different roles. But if I could try to be concise here, I would say that, maybe part of the reason that KB, the one and only, our fearless leader, is out in the forefront and everybody knows him and nobody knows me as much, right? Is because of the relationship that we have. For those that are familiar with Gino Wickman and the EOS business model, Kevin serves as the visionary of our organization. He's the serial entrepreneur, just the visionary doing a million different things, ideas for days. And I serve as the integrator in the relationship inside of the business. And if I could use an analogy, basically, I talk about KB as a trailblazer, the guy that is always coming up with a million ideas and is just blazing his own trail. Like if we were in a forest, Kevin is just blazing through this forest, knocking down trees left and right, creating an exorbitant amount of chaos, doing everything that he can to frustrate everybody behind him. And I'm the guy behind him feverishly trying to scurry and organize everything that you're doing along the way, right? To try to organize all that stuff. And I feel like that's maybe kind of the way that the relationship has been for many, many years. And over time, we've been able to do some neat things, and we've evolved and been able to remove and delegate and elevate as we've brought on super talented guys in various different areas of our business. But today, I primarily focus on the investor relations side of the house, as well as legal compliance, right? So spend a lot of time with limited partners, working on our fund and try to provide white glove service to everybody involved throughout the entirety of the chain. So that's primarily what I do on a day-to-day basis, bud.
Well, you do a great job cleaning up the messes, my friend. I appreciate all that you do. You made mention of the investor relations side of the business, that you deal with a lot of the limited partners that we have in our various different opportunities, and so I think it'd probably be a good time to maybe make mention, not let the entire cat out of the bag, but about the new podcast coming soon that we're going to be launching, that you're going to be launching. And so, guys, given that, again, Brian has spoken with, literally hundreds or thousands of limited partners over the years. He's going to be the host. He's going to be launching a new podcast. He's going to be the host, and we'll be speaking specifically on how to be a successful passive investor or, limited partner. Again, the amount of experience that he's obtained over the last decade plus of dealing with all these limited partners, the different investors, but also even he himself being a limited partner in a number of different syndications. I guess you could say he's probably learned a thing or two along the way, and he's going to be bringing that knowledge to you each and every week through the Real Freedom Through Investing podcast. And so, Brian, super excited about that. And guys, we'll provide more information here in the coming weeks and months, but super excited for the launch of that show. I know it's just going to be jam-packed with a ton of valuable information that you're going to be sharing with folks each and every week. And so with that, again, don't want to let the entire cat out of the bag here, but super excited for the show, my friend.
No, I mean, I am as well, right? I mean, one of our core values inside of the company is be a sponge, right? We're lifelong learners. We're always trying to iterate and improve, voracious readers, learning everything that we can along the way. Early adopters of podcasting, obviously, and be a sponge inside of our organization means continue to learn and basically absorb all that respective information, but don't be so selfish as to keep it to yourself. Once you've kind of learned different things that you feel can help others, ultimately share that as a sponge would, absorb all that water and share that information with the world after the fact. That's exactly what we're trying to do with this podcast. We've put out a ton of stuff on the active side, as you well know, right? But we get a ton of inbound from folks requesting that we put out more information to try to educate passive investors about some of the more advanced passive investment strategies, tips, tools, tactics that we've learned along the way so that we can help them along their investment journey. In any event, super excited about it, buddy. And hopefully we'll be able to add a ton of value along the way. That's the goal.
No, it's going to be awesome. It's been years in the making. So super excited for the launch of that. And, buddy, so what I was thinking with the show here today is, again, we've been at this now a couple of decades, kind of wrapping up our third fund, hundreds of different real estate transactions over the years. And I thought that it would be valuable, given that we're coming up on this big milestone here of the closing of Fund 3, to kind of go through, maybe the biggest lessons that we've learned over the last 2 decades of being real estate investors. Again, 3 successful funds and several $100 million worth of real estate transactions. There's been a lot there, and surely we don't have time to go through every different component or lesson that we've learned throughout that period of time. But I thought it'd be helpful maybe if we go through some of the big ones, like the big takeaways. Again, just over the last couple of years that we've just experienced personally as we've grown the company, as we've bought a number of different investment properties and what have you. And so I think the first one, just unless you got other thoughts here, but the first one I love to kind of hit on is just buying with a margin of safety. This is something that I learned early on. My very first mentor, he taught me a very basic formula back when I was buying single family investments. And that was, never pay more than 65 cents on the dollar after factoring in, the repairs that home needs to get it back online and turn it into a rental. And so, literally from day one, the first lesson I learned was don't overpay for a property. It's something that we've basically integrated into Sunrise Capital Investors. And so anything that we buy, any investment deal that we've ever bought through Sunrise, we're buying at a hopefully a significant discount, but no matter how you look at it, there's a margin of safety of what the actual intrinsic value of that asset is to what we're actually paying for it on the front side. And so, that's very important to us. I don't know if you'd like to elaborate there or not, but, first and foremost, make sure that you've got a buffer there against, especially given the times that we're in today, right? Everyone knows that there's distressed assets that are out there, probably more to come, lots of floating rate debt that's causing some pain in the marketplace, and not just in the office space, which everyone knows is in trouble, but more specifically throughout any asset class that's got maybe floating rate debt or people overpaid for it. Right? It was a frenzy during 2021 and 2022. People were just buying everything they get their hands on, and a lot of times overpaying for it. So again, would love to have you elaborate if you would, Brian.
Yeah, I mean, I love every bit of that, and I share the sentiment. I mean, it really is one of the foundational pieces of what we do here at Sunrise. And it really does just harken back to you and your investment journey, right? Many folks know that have been podcast listeners for years and years, but some of them probably don't. But I mean, your background here, this stems from Kevin's background of 20 plus years doing this. I like to say Kevin's never had a real job. Started buying real estate when he was a teenager, and by the time that he was in his mid 20s, he built up a really large portfolio, about 125 single family homes, doing exceptionally well, right? And I'll brag on you a little bit, right? Multi-million-dollar net worth, doing very well. Life is good. But then the Great Recession hits. And ultimately, unfortunately, had to give some of those homes back to the bank, decided to walk away from some of those. And now, as we progress, we grow, we iterate, we improve, we focus on real estate investing for cash flow, hence the name of the ultimate podcast. And then focus on commercial real estates, as opposed to the single family rental stuff, so that we can have multiple different, assets, multiple different streams of income from one respective property. Having a little bit of diversification there, but focusing on cash flow as the primary metric that we underwrite, so that we ensure that we can ride out any of those inevitable recessions, right? Because it's coming, right? We know over long periods of time that the economy will ebb and flow, and you need to be able to hold assets over extremely long periods of time. And one of the main ways you could do so is by just buying with a margin of safety, right? That foundational piece of what we do. I don't think you've ever paid full price for anything ever in your life, real estate notwithstanding. I'm talking about boats. I'm talking about vehicles. I mean, this guy, over the last decade that I've known him, has bought an exorbitant amount of vehicles off of Craigslist, used them for a couple of years, sold them, same location, Craigslist, for a higher price than he bought them for a couple of years prior. It's just embedded into your DNA to not pay full price for anything. And I love every bit of it. It's a beautiful thing. We all benefit from that, buddy. It's phenomenal stuff. It's a foundational piece. And we try to espouse a lot of the same investment philosophies that the great Warren Buffett does. There's a reason that the guy built a business from $0 up to $700 billion in one generation. So we lean on a lot of the different investment philosophy that he implemented in his business. And, he's quoted verbatim as stating the three most important words of investing are margin of safety. So
yeah,
protect the downside. Right?
Yeah,
one, don't lose money. Rule number two, don't forget rule number one, right?
I love it. And it's also speaking to, another lesson, big lesson I learned, aside from just, buying with that margin of safety, buying, below market value, was to not over leverage assets. And I'd say that probably wasn't even a topic of discussion very much at all over the last couple of years, up until maybe 6 to 8 months ago, right? Until the Fed started really pushing rates. And now it's the primary topic of discussion. And, we've always been incredibly conservative. I know that you and I have always had kind of our back and forth with debt, but we've always landed on the sentiment that, there's only really one thing, again, lesson I learned way back in the day. There's only really one thing that can destroy a real estate investment, right? And it's really the debt, or that can really take it on a downward spiral outside of just overall, operational performance, meaning like, managing the property efficiently. It's really the debt side, is getting over leveraged and ultimately having a scenario where you've got negative a negative debt service ratio, to where it's actually the incoming cash flows are not covering the debt service. And a lot of folks are finding themselves in that situation here today. Again, we've probably passed on a lot of deals, Brian. I know that you'll agree with this. We probably didn't buy a number of deals over the last couple of years that we ultimately could have, but we didn't want to overpay. We wanted to have that margin of safety. Now we find ourselves in a very safe position, maybe hadn't scaled as much as what we could have, but find ourselves in a very safe position with that margin safety, but also a very low leverage point on the debt side. Again, just not getting, like how you normally put it, getting out in front of our skis, right? With the debt piece of it. And so again, I think it's just really important for folks to understand, especially as we go through this downturn in this part of the economic cycle. Because at the end of the day, if you're investing today, maybe you just started as a real estate investor, maybe you've been investing for a couple of years, we're going to go through another cycle at some period of time, right? No one knows how long this cycle is going to last. No one knows what the bottom really is, what the bottom looks like. No one really understands when that upswing is going to happen. But I can promise you one thing, that we will go through another economic cycle or real estate cycle where things will bottom out, things will top out again, and they'll go right back down the other side of that roller coaster. So with all that being said, taking a more conservative approach, we feel, is in not just only our best interest, but also our limited partners' best interest, and also the interest of our overall investment philosophy, which is holding assets for the very long term. So again, Brian, I don't know if you'd like to add anything else to that.
Yeah, I think that you hit on a couple of really solid points there. I would just reiterate the fact that, again, a little bit of push and pull over time, just in terms of owning the company. You want to scale, you want to continue to grow. But I think that this stern philosophy of buying with a margin of safety, not getting out in front of your skis from a debt perspective, to a degree has precluded us from significant scale, and can at times be frustrating as you see a lot of maybe more neophyte folks coming in over the last handful of years scaling to the moon. However, it's not about getting to significant scale. Ultimately, there are a lot of individuals that have run really, really quickly over the last handful of years. And unfortunately, much like the old Roman Empire, if you scale too quickly and you don't have a really exceptional foundation at the core, that could ultimately create some ripple effects and adversely affect the entirety of the portfolio as you're rolling forward. I'd rather build slowly but surely, one brick after one brick, to ensure the portfolio has staying power in the marketplace. Because ultimately, long-term investment success is the best path towards an extremely likely outcome. Real estate, it's not about timing the market. It is about time in the market, being here for long periods of time. It's why we focus on real estate investing for cash flow, having a sound DSCR. It's why we focus on buying with a margin of safety. It's why we have relatively modest LTVs. It's so we can hold assets over a long period of time, because we know that we're not interest rate prognosticators. We're never going to know exactly what time the Fed is going to raise interest rates or cut interest rates. We'll, of course, keep our finger on the pulse. We'll do our best, but nobody will know. And I can prove it to you, because if you listen to what the Fed said 18 months ago, they were lying to you. So the Fed doesn't even know where the Fed is taking the interest rates, right? So nobody knows. You can't be an interest rate prognosticator. So you have to be very conservative with the portfolio and have the ability to hold over long periods of time, because that's what ultimately creates the best outcome for everybody involved. Real estate is not a get rich quick sort of business. It's not a get rich quick business over a short period of time with a modest likelihood of success. This is a build large amounts of wealth over a long period of time with a very high probability of success, so long as you have staying power in the marketplace. And that's what we try to do inside of the business. But I'll stop rambling, man. A lot of info.
No, it's all great.
I agree.
No, just again, not to keep just hitting on this one point. I think we've hit a lot of different points with inside of this, but it's, I'd say that, and you can speak to this because you talk to most of our investors, but a year ago, the most common question did not revolve around, where are you guys at from like a debt perspective, from either perspective or new investors that were looking to invest with the group or with Sunrise, or already have an investment in Sunrise. The question never ever came up as to, what's the business strategy related to buying new investments or refinancing? Like where you guys, what type of debt do you put in place? What's your LTV? Do you guys use floating rate debt, fixed rate debt? What does that look like inside the organization? that just never came up. But I know that you had made mention many times now over the last, at least the last 6 months, that it's probably the most common question now. And it's one that never existed before. Investors are having challenges in other investments, in other, maybe it be a multifamily syndication where distributions have stopped. They've stopped because maybe that loan, maybe it's a floating rate loan, and the actual cash flow or the income can't cover the debt service, and it's in a very precarious state, a state of distress, and distributions have stopped to limited partners. And so again, just back to being conservative and having that, buying with the margin of safety, but also being conservative on what type of debt we put on property and how much we leverage properties. It just, again, revolves around our overall investment philosophy and who we are as individuals and who we are as investors, and how we look at just each and every deal that we bring into the fund. So again, don't mean to keep being a dead horse here, but I think it's important to speak to, especially given the time we're at in the marketplace. So
I share the sentiment, right? Talking about the debt strategy a little bit. Of course, we want to try to have our cake and eat it too. This is how I try to explain it. And again, as you mentioned, thousands of over 1,000+ conversations with partners over time. And historically, during the crazy run up in the last handful of years, more often it was associated with trying to, how much money can you make me? More focused on the rates of return generated. And, a pro forma is exactly that. It's a projection. And the only thing that I could say about a pro forma, whenever we send anything out to folks, is basically it's going to be wrong. It's either going to be better or it's going to be worse, but it's never going to be perfectly exactly whatever the pro forma says. It never is. And anybody could put anything on a spreadsheet and show you whatever their projections would like to be. But we always try to be mindful about under promising and over delivering to the best of our ability, And now today, the conversations are much more in depth, as you're mentioning, right? Much more in-depth, more granular conversations. It's a beautiful thing. Investors are getting significantly more educated over time. Love every bit of it. Much more granular questions associated with our debt strategy, this, that, and the other. But it's a function of the time, because people are starting to now have a little bit of pain in the marketplace, right? Some of those guys that were scaling to the moon sometimes were successful in spite of themselves, even though they may not have had the most well thought out, in-depth business model over time. They were fortunate to time the market well, which was a good thing while it lasts. But unfortunately, during these sorts of scenarios, maybe some limited partners have experienced, a pause in distributions, stopping distributions, and God forbid a capital call where they have to make an outbound, inbound, a cash in refinance, if you will, as opposed to the old cash out refinance where they got to cut a check back to the sponsor, et cetera. And it's making the conversations that we have a little bit more in depth about our debt strategy. So briefly stated, right? Trying to have our cake and eat it too. The deals that we do, right? We always try to buy with a margin of safety, like you're saying, go off market, direct to owner, try to buy with a margin of safety where the purchase price is A and the appraised value at acquisition is higher than A, whatever that is. And we call that our margin of safety. Great. It's a beautiful thing. We've been fortunate inside of this fund, buy $100+ million of assets, appraised value, $130 million of assets. Unbelievable. Just by virtue of Kevin going off market direct to owner, leveraging that core competency. It's an amazing thing. But that doesn't even include the additional value add that we try to achieve after we acquire the asset. Everything that we do is going to have some sort of value add along the way. Might be it recapturing a loss to lease over time, improving the operational efficiency of the assets, a litany of different levers we can pull to try to increase the value of the assets. And for this reason, whenever we buy a deal in terms of the debt, we don't like to put long-term permanent fixed rate debt on the acquisition immediately day one, because while it's a good thing to lock in fixed rate debt for a kind of a 10-year term, if you will, which is often the case in Fannie debt, et cetera, CMBS, Lifeco debt, that's a good thing to have that sort of term so that you have holding and staying power and predictability of outcome. The downside here is that you don't tap into any of the value add really, as much as you otherwise might be able to. You might be able to do a little supplemental, but you really can't do a real substantive cash out refinance if you have Lifeco debt on, CMBS debt, or Fannie debt, because you'd have massive yield maintenance penalties, defeasance, these sorts of things. And that precludes you from being able to tap into the value add that you're able to create in the first couple of years of ownership, right? Our value add plan, we're typically able to turn the deals around in 18 to 24 months, at which point we would like to be able to tap into some of that sweat equity that we've created. And for that reason, we like to really negotiate with national banks, regional banks, so that we can have that long-term fixed rate debt, called a 10-year term with a fixed loan. Sometimes they'll only give us 7-year term. Sometimes they'll only give us a 5-year term, maybe a 5+5, but we can fix it over a good amount of time. And then we have the ability to kind of negotiate on the front end a shorter prepayment penalty, right? Where we,
Yes.
might have a 2-1-0 step down prepay, where in the first year, if we replace that loan, we pay a 2% penalty. In year 2, we pay a 1% penalty. But starting in year 3, we basically have the ability to do a cash out refinance without any penalty, should we choose to do so, and basically just watch the market. So we can hold the property for 10 years with the same loan, or alternatively, start doing the cash out refinance in year 3, whenever market conditions warrant, just sitting there watching Jay Powell and the Fed, eating popcorn, wondering what they're going to do. And then when it makes sense, when market conditions warrant, go back and do a cash out refinance and ultimately send capital back to investors in a non-taxable event. So that's what we try to do. Have our cake and eat it too. Have staying power with a long period of time, but also be able to tap into the refinance when market conditions warrant. So anyway, that's what we look at. And elaborating further, making sure that the LTV is not crazy, right? 60, 65, 70%. Anyway.
Yeah, no, I like to call those safe bridge loans, right? They're not really bridge loans, so I don't want to confuse folks. But again, using a local bank that's got at least a fixed 5-year term in place, sometimes longer than that, and again, negotiate the prepay on the front end. That way, we can get in, have plenty of time to execute our value add strategy. But then also, if the market timing doesn't warrant, let's say 2.5 years in, to do a cash out refinance, we still got plenty of time left where we don't have to worry about the rate going to an adjustable or floating, what have you, and causing a lot of the risk that is presenting itself today in the marketplace. Brian, with that, I love to, again, trying to get back to we summarized a ton there, and that's, lots of lessons learned, lots of information shared. Just again to step back and again try to provide even a wider summary of lessons learned over the years. I think another one comes to mind, at least for me, is it's one of our core values of Sunrise Capital Investors, and it's enjoy the ride. And that might mean something different to each and every listener here on the show, but I think, and I'll let you speak for yourself, but what that means to me, and as we build this company, and for me, first and foremost, it's family first, right? I'm a family guy. I'm a father. I'm a husband. I've got two younger boys, and I reflect back of why am I doing? Why are we doing? Why am I doing what we're doing here? We love what we do. I love what we do here in the organization. But what's of the most utmost importance, and it's enjoying the ride along the way. And to me, enjoying the ride means getting the freedom and flexibility to spend as much time as possible with my family and create a lot of incredible memories together. And so I know that that means similar things to you, but I'm not going to put any words in your mouth. But again, just enjoying the ride, just having a purpose behind what it is you're doing. And so agree. Feel free. I'd love to hear from you, Brian, because I know we talk about this, but again, would love for you to share, with the listeners, kind of your perspective. What's that definition to you?
Well, to me, this is great. I love every bit of it. And, whenever you're starting a business, you have to understand and think critically through why you're doing what you're doing, and have at the center of your business core values that ruminate throughout the organization. And enjoy the ride, simply stated, is about putting family first, because life is too short. Nobody at the end of the rainbow, when they're on their deathbed and they're saying, what do I wish I would have done differently? Nobody says, I wish I'd have worked a couple more hours. I wish I would have made a little bit more money. Everybody says they wishes they would have spent a little bit more time with friends and family along the way, experience more life, these sorts of things. And that's what enjoy the ride means. We're going to be, fortunately, right, if we continue to iterate and improve and make strides one foot in front of the other the same way that we have, we'll be so fortunate to create a very successful company and help a ton of people along the way. Love that. But at the end of the rainbow, right, it's all about putting family first and having enough time and freedom to be able to do what you want with your friends and family, and bringing on teammates. I think the big point here is bringing on teammates that share those same exact core values. Nobody inside of our organization, we tell this to everybody that comes on board, nobody inside of our organization has ever missed any sort of family event that they have ever wanted to attend, for vacation or otherwise, immediate events, emergencies, things of this nature. If anybody has ever requested time off, they have always been granted time off. We don't have any sort of paid leave where we kind of manage with an iron fist, overseeing people in that manner. Anybody who has ever wanted time off has always been granted such, because we're a meritocracy. So long as folks get their jobs done and get things accomplished, life is good. Feel free to go do what you would like to do. And we always put family first. We would never want anybody to thrust kind of that, iron rule with an iron fist management style on us. So we would never do that on our teammates. And people, I think, appreciate that. So we want to have fun while, helping as many folks as possible create cash flow and build legacy wealth for them and their families. That's what we try to do. And for me, we're really trying to help people create real freedom here, enjoy the ride, and ultimately create real freedom through passive investing. Freedom of time, freedom of money, freedom of relationships, freedom of purpose, all sorts of freedom, so that you're feeling fulfilled about what you're doing. It's not about adding another zero to the bank account, adding another zero to the income. It's about having, freedom, right? Using money as a tool to allow you to do what you want to do with your friends and family whenever you'd like to do so. And again, trying to circle back to what enjoy the ride means, right? Freedom of purpose. You got to have some purpose in doing what you're doing. You have to feel fulfilled. It's ultimately kind of hearkening back to enjoy the ride, why 72 hours to Key West even exists. And why we named it Enjoy the Ride, because of you, your background in cycling, why we have a charitable foundation that every single year we go out in the fall, put on a charity event, and over time we've raised hundreds of thousands of dollars and donated to charities that we love, because that is helps you feel fulfilled. It's about freedom of purpose and enjoying the ride along the way. So you feel free to elaborate, buddy.
No, I love every bit of that. And I think I'm going to flip it back to everyone that's tuning in here listening. And I think the importance of this message, and, kind of what Brian and I have learned over the years is, and as you either maybe you establish your business, or as you grow your business, depending on where you're at along in your journey, or maybe you're just maybe you're not starting a business, maybe you're a passive investor. You're looking for, ways to basically turn your earned income, your W-2 income, into passive income, so that you can find more time with your family and more flexibility within your life. And it's the, the why, right? Really, figuring out what is your why. Why are you doing what you're doing, and really having a strategy behind it. And so I know nothing else to add other than that, Brian. Just really putting it back to those that are tuning in, that it's of the utmost importance with whatever stage you're at in your investing journey. Again, whether you're building your own company or you're looking for passive investments, but just really figure out, why are you doing what you're doing, and actually have a legitimate strategy built around that, so that you can ultimately achieve what it is you set out to achieve. Nothing else to add there. But I think again, back to the summarization of lessons learned. Another thing I know that is, you and I both share the same overall investment philosophy and thoughts and perspectives on, is that real estate, it's not get rich quick at all. I mean, don't get me wrong, you might hit one out of the park, right? You might hit a home run on a particular deal and just absolutely crush it. But really, and real estate needs to be looked at, as a long-term strategy, a long-term game, and not really timing the market, but again, rather, I know you love the saying, I love the saying, it's time in the market, not timing the market, but time in the marketplace, and just being patient. Real estate is a patient investment strategy. And it's how we look at every different investment that we buy. We go in with eyes wide open, looking to buy great investments and great marketplaces with a margin of safety that we would like to hold for the long term. And again, we hit them out of the park in once in a while, but really nice doubles, singles and doubles, and great markets that will produce not just cash flow today, but cash flow for many, many years to come. And would love if you want to elaborate on that, Brian, at all.
Yeah, and I mean, again, it's reiterating Warren Buffett's background and story, right? Here's a gentleman who started from absolutely zero and built a $700 billion portfolio in one generation, because he buys with a margin of safety, focuses on the long term, and never pays taxes along the way. It's why we have, I would say, evolved and iterated and improved our investment philosophy to kind of emphasize a one-time investment and lifetime cash flow inside of the fund structure. We've done a lot of different deals, gone full cycle on a lot of different deals, buy, fix, and sell. Nothing wrong with that. Send big checks back to investors and generate an outsized IRR, right? That's nice, super flashy, all great stuff. Love every bit of it. But that creates problems. I'll never forget a story that I'd had with an investor that ultimately invested several $100,000 in one of our earlier deals. And we ended up, doing a buy, fix, and sell strategy. And it was a phenomenal investment, ended up doing very well. I was super excited to jump back on the phone. Guy invested $500,000, sending him a huge check back. Life is good, more than doubling an investment in just a handful of years. And I was so excited to jump on the phone and kind of give a congratulatory tone about you know, the phenomenal return that we were able to generate, super excited about sending him this big check back. And I'll never forget his response, which basically took me, you know, basically I was taken aback by his response, where he basically said, "Why would you do that to me? Why would you do that to me?" And I was, you know, I asked him to elaborate because I was kind of shook. I was taken back. I was surprised to hear that, given the fact that I thought, done a good job on the respective investment. And he went on to elaborate and convey to me that ultimately, by virtue of us selling that investment, he was going to end up having to pay hundreds of thousands of dollars in tax. And he felt like that was ultimately going to rob his next generation of hundreds of thousands of dollars of their net worth, the next, you know, a leg up in their investment journey, that the government was ultimately going to rob from him. And then secondarily, he now had to go do some additional work to try to find another investment. And that investment had to generate a better rate of return than he was going to, than we were already generating along the way. And I say better rate of return, because there's a drag, a lag in time between when you sell asset A and when you buy asset B. So he's got to do a ton of work, got to go find another asset that's ultimately going to generate a better rate of return, because there's a cash drag and an opportunity cost in that interim period of time where you're not making money and you're not investing as much money along the way because the government took hundreds of thousands of dollars from you along the way. He would have much preferred to just have non-taxable income from cash out refinance proceeds, continue to grow the portfolio over time, enjoy the cash flow that you throw off along the way. It's just a better way to build compound wealth over time. It's why we ultimately have sought to create structures that allow us to implement the Warren Buffett investment philosophy of ultimately helping folks generate a snowball, in an effort to help folks generate a snowball and do so in the most tax efficient manner possible. So that's what we try to do over very long periods of time. We're certainly imperfect. We'll never claim to be, but I mean, we're always trying to find ways to iterate and improve. And any of that iteration is always based on feedback that we have from our partners along the way. So that was one thing that I'll never forget, buddy. That was an impactful conversation along our investment journey.
No, I think that's a great example. I mean, and kind of what I take from that is depending on, again, who you are. Are you an active investor? Are you a passive investor? But just assuming you're a passive investor. If you're on the passive investment side and you're out there looking at different syndications, is really ensuring that whatever you've already identified what your long-term strategy is or your investment strategy is, and ensuring that whoever you're going to put your capital with actually has an alignment of interest with that same strategy or similar strategy, right? And so that you're all rowing in the right direction. Similarly, with active investors that are maybe building a business similar to that of Sunrise Capital investors, just again ensuring that the limited partners that you bring into the fray, that you bring into the organization, that you partner with, that they are very clear of what your investment strategy is, and does it align with their own, and just having that, you know, out in the forefront, and you know, being proactive with identifying what it is and ensuring that you're, you know, putting your dollars in the right place and your investment in the right place, I think is of the utmost importance. And again, Brian, you could probably speak maybe more to that on the investor relations side and what you've seen and what you've heard through the years. But I'm sure that it's something that some folks, you know, I think, just thinking back over the last couple of years, I think a lot of investors, and I'll speak to limited partners, I think might have found themselves in a IRR drunken state, right? Just really only focusing on that pretty IRR number that gets put out in the pitch decks of different investment opportunities, and not realizing or understanding what the overall investment strategy of that particular syndicator is. Again, speaking from the passive investor's perspective, and again, going back to the story that you just shared, it sounds like there might have been a slight misalignment of interest, and it happens. And so with that, you know, just of the utmost importance, and it came to mind after you shared that story there, Brian.
Yeah, no, I mean, great stuff. I'll piggyback that. I'll jump in a little bit. I think that sometimes to your point, a lot of folks over the last handful of years may have been just focusing on the internal rate of return, trying to drive that, trying to juice that. And there's nothing wrong with that per se. It's an important metric whenever you're looking at a real estate investment. However, as the old adage goes in real estate, you can't eat IRR. And folks that focus exclusively on that one respective metric sometimes are myopic and short-sighted, because you can drive a massive IRR in a short period of time by trying to time the market perfectly, but you're taking undue risk by focusing exclusively on that. And when you step back and take a more long-term approach and you look at all the different various metrics inside of the game, I think also just from an investment perspective in general, folks should think about this not as a real estate investment, but rather an overall allocation of your entire investment portfolio. How much capital do you have allocated to stocks and bonds and real estate? The truth is, I think that the vast majority of society, just your average layman throughout the country, is woefully under market in terms of the allocation that they have to real estate. The vast majority of folks, stick capital in the 401k and the self-directed IRA, and only because that's what the government tells you to do. But it's kind of, I would say, almost been proven here now that a more diversified portfolio allocation with a higher degree of ownership in alternative investments such as real estate typically outperforms, looking at the Yale endowment model and how that has performed over time, comparatively speaking. And I think more and more folks over time are allocating more and more of their portfolio overall to real estate for that exact reason. It allows you to achieve not only better returns, but also lowers the amount of volatility that you experience along the ride, which is a beautiful thing. So folks, I think, need to have a more long-term philosophy, thinking this is not an investment that I'm looking to make over the next year or 2 or 3 or whatever the case may be, but rather this is a portion of my portfolio that I'm allocating to real estate to try to smooth out my overall investment portfolio ride, create the best risk-adjusted returns that I can for myself and my family, and just have a long-term investment philosophy, knowing that this is a long-term allocation to real estate. That's how I feel. And that it kind of reminds me of the folks that ultimately do better by virtue of thinking about things over long periods of time. It reminds me of the Stanford marshmallow experiment. The specific name eludes me, but you guys, the marshmallow test, right? It was a study that was done at Stanford where basically, you've probably heard about this, where the scientist goes in and he has a bunch of kids lined up, and they put one kid in one room at a time, and the scientist goes in, he's got 2 different marshmallows, and he puts one marshmallow in front of the child. The child's 6, 7, 8 years old, and he says, "All right, I'm going to make you a deal you can't refuse. Something, a great deal, best deal in the world, right? I'm going to give you a couple of marshmallows. I'm going to give you this one marshmallow now," sets the marshmallow in front of him and says, "You can eat it now, or you can eat it later. If you eat it now, I'm going to leave, and I'm going to come back, and it won't be too long, but I'll be back in a little bit. And when I come back, if you've already eaten that first marshmallow, I'm not going to give you the second marshmallow. But if you have not yet eaten that first marshmallow, I'm going to give you a second marshmallow." And some of the kids decided to smash that marshmallow as soon as the guy walked out the door, 15 seconds afterwards. And some kids were just extremely patient, waiting patiently for the man to inevitably come back into the room, at which point they get that second marshmallow and basically double their investment. And silly as that small Stanford experiment is, they ultimately followed these children over decades in a longitudinal study that ultimately showed that the individuals that could have and experience delayed gratification ultimately were able to achieve significantly better investment portfolio success than that which the individuals that had the impulse of trying to drive for the gratification immediately. And I would say that it kind of harkens back to just investment in general. The folks that were kind of chasing these outsized yields over a year or two without thinking through over long periods of time, having a more conservative investment. From our perspective, we're always thinking long-term, long-term, right? As Warren Buffett says, if the stock market shut down over 10 years and I buy a stock today and the stock market shut down 10 years, I'd be comfortable holding that for 10 years. We feel that same way about real estate, right? Yep. That's why we focus on mobile home parks. More gobbledygook here. Mobile home parks had the highest long-term same-store NOI growth out of any respective real estate sector. That's a fancy word for simply saying it's got the best compound interest out of any respective sector. So we prefer to hold the assets over long periods of time and let the macroeconomic tailwinds do their thing. So anyway,
yeah, no, that's I love the marshmallow example there. That's fantastic. And just speaking to mobile home parks, Brian, you have the best same store NOI growth over any other asset class. But I think also to speak to why we love mobile home parks, there's many reasons, but so that's for another show. And we've talked about it many times over the past, but it's the only asset class that has a diminishing supply. So there's a massive supply demand imbalance. Over the last 10 years, we've seen the demand for this asset class grow significantly, and the supply has continued to dwindle, and the asset class continues to get consolidated. And so, when we find great opportunities and great markets that have great upside potential, we want to buy them, but not just buy them from a short-sighted manner, but really look at the long-term opportunity, knowing that more than likely there's a 99.9% chance that there will not be another mobile home park developed in that particular marketplace. There will be no new supply that comes in the market that threatens that, that community. And so that's just a huge plus. I mean, you can't really speak to that same defense mechanism with multifamily or really any other asset class, multifamily, self-storage, office, retail, what have you. There's continual new supply coming in the marketplace. And that is just not the case with mobile home parks, nor is it the case really with parking assets. We haven't spoken to parking assets, and I don't think this is the show to do that, but mobile home parks and parking are the two niches that we've chosen, and we've chosen them for very specific reasons. And so, and Brian, we've shared a lot of great information on the show here, and I hope that everyone that's listened has found great value in tuning in here over the last, roughly 45, 50 minutes. And, but with that, I'd also want to be considerate of the timing here as well. And any final thoughts, I guess I would leave it at, Brian. Any final thoughts as far as lessons learned, again, over the years, over the decades that we've been doing this, and more specifically over the last couple of funds, or even our most recent Growth and Income Fund 3?
Yeah, I think that I would leave with one, as you always say, one golden nugget. Any other golden nuggets at the end of the podcast? I'll leave with one. And it is that right now, we're starting to see headlines, right? You see some of the things coming across. Multifamily property value drops 20%. Office property value drops 20, 30%. And ultimately, it's creating a little bit of concern from a limited partner's perspective. Maybe folks more sheepish about pulling the trigger and allocating capital to a real estate investment. But what I would pose to you is that those properties that are ultimately down 20, 25, 30%, the time to be sheepish would have been 2 years ago when that property was ultimately purchased with a ridiculous floating rate bridge loan, and the term is expiring in the not too distant future. And those are the individuals that are now experiencing difficulties in the marketplace with distributions being paused and potential capital calls and all these sorts of things. But if you think about it completely objectively, when you go to the store and something is on a discount for 25 or 30% off, is it not a good time to acquire assets? Warren Buffett always says, right? Be fearful when others are greedy, and be greedy when others are fearful. Right now, all of the headlines are impending doom, crash coming, this, that, and the other, things down 20, 25, 30%. When you look objectively, have a very long-term investment philosophy, we try to scoop up assets when they're on a discount. And that is the intent today. So just, I would caution folks to only read the headlines, turn the page, and move on, but rather think critically about what time we are in the market. As the Fed has increased rates 11 times over the last 18 months, now it's 5.25% to 5.5%. I would pose to you that we're closer to seeing the light at the end of the tunnel on the interest rate increases, and rather we're going to be on the downward slope in the not too distant future, which typically means you're never going to time the market perfectly. You're never going to time the market perfectly. You never want to catch a falling knife, as it were. We're not going to be perfect at the very bottom. However, over long periods of time, we're probably more close to the bottom when things are 20, 25, 30% off than we are at the top, which was just a couple of years ago. So with that, I'll get out of here, buddy. That's just my nugget.
I love it. And I appreciate you joining. We need to do this more often, buddy. You got your own podcast coming on, so you're going to have your hands full with putting out a lot more additional content. But no, I appreciate you joining me here, buddy. It's always fun to have these collaborative conversations, and I think even more importantly here on this medium that we're getting to share kind of our inner thoughts with folks that might find value in this. Again, depending on what side of the aisle they're on. Again, whether they're a passive investor or growing a business such as Sunrise Capital is. And so anyway, just enjoyed your time here with me, and appreciate you sharing all your insights. And, for those that, that are listening in here today, just want to thank you for joining us here. Honestly, we wouldn't be here if it weren't for you. So just thank you for your time and taking the hour out of your day to listen in here, and hopefully you walked away with a few gold nuggets, more than just one, hopefully a couple gold nuggets, as we've shared again our perspective on the different lessons we've learned over the years here. And for those of you that maybe share our own investment philosophy, what we talked about here today and share our core values, and you want to learn more about, what it is we do. We're always available to hop on a call and talk shop with you, to see if we can maybe help you in your quest, to making, good, solid real estate investment decisions. Again, we're always available. Someone's always available to hop on a call, and would love to participate in your real estate investing journey. And with that, I'm going to do one last shameless plug here, guys, because we can, and that's, again, I want to remind you for the Fund 3 closing August 31st. If you guys are looking to allocate capital here, here in the next couple of months, again, we built up quite a significant amount of equity over the last 2.5 years that we've been running that particular fund, and have 2 final deals that are closing inside of Fund 3, which will take it to a total of 11 assets. Again, $20+ million of sweat equity already built in, distributions being handed out on a quarterly basis already. So again, if you're looking for a place to allocate capital, go over to investwithsunrise.com. You can learn more about not just the investment opportunity, but even about each respective deal inside that fund. We've got links to appraisals, overviews of the deals themselves that are inside that fund. Anything that you would want to learn about each individual respective deal inside the fund, it's on our website. Again, investwithsunrise.com. And with that, Brian, I'm going to call it quits, and we're going to wrap it up for the day. Okay.
Yeah, great stuff, man. If you're so fortunate, maybe I'll invite you on my podcast, and then
yeah. If I'm so fortunate, I love it. All right, brother. I appreciate it. Appreciate all you guys coming on. You have a wonderful day, and we'll talk soon.